Hello traders, James Stanley with StoneX and Forex.com. I wanted to look at the US dollar as we go into the month of March. February was largely a month of recovery. January was a strong sell-off to end the month. But so far in February, well, or through February, we've seen buyers get back on the bid. We've seen price push back up. There's a major level of resistance that is still in play. And like I've been talking about, I think this is going to be highly determined by whether or not we can get a breakout in dollar yen. In this video, I want to explain why, I want to explain how, and I want to look at a few options, especially a couple of options in case we do see failure on the long side of the USD. So let's get to the chart and start chopping this up. So first and foremost, the formation that I was speaking of is an ascending triangle formation. Those are bullish breakouts. And I had looked at this in last week's video, and it's still in play. The resistance level that I was speaking of is 97.94. That's the 38.2 Fibonacci retracement of this major move going back to 2008, drawing that up to the high in 2022. More importantly than that, because that's just theoretical, but in the actual, this is what helped us set this low back in April of last year. You could see really well on the weekly chart where this was a spotted delineation where sellers took their time to get below it. Once they did, it showed up as resistance a couple of different times. Then back into support, it was this last kiss of a lower low before we got to a lower high, and then a breakdown that ran into January. For the past, or 3 of the past 4 weeks, this has been resistance. On the daily chart for 5 of the past 7 days, this has been resistance. Bulls just have not been able to leave this behind. And I think there's a valid reason for it. I talk about this often in USD because when you look at DXY, it's just a basket. It's a basket of underlying currency. So if we're going to see that strength play, we need to see weakness somewhere else. The euro is a big part of that. It's 57.6%. The Japanese yen is a big part of that, 13.6%. I think the yen is still the major decision point as to whether or not we get that breakout in the USD. And that, I think, remains a challenge that I'm going to get to here in a moment. For now, I mean, you got to call this what it is. It's consolidation. And it's a consolidation after a massive sell-off. It is a bullish breakout setup, so I think there's still a case to be made to bias this on the long side. But with that said, I think we're going to need to see a couple pieces fall into place to make that happen. But as illustration of what an ideal ascending triangle will do or show if it breaks out as anticipated or as hoped, maybe, we had one in gold. Looked at this last week. This was a beautiful setup. It was, and still is, a very strong technical backing just for prior price action. So we had that steep 3-day sell-off in the end of January, and really it was just 3 days, but it wiped out pretty much the entirety of January gains at one point. It was a vicious bounce from that. We ran all the way up to 5,100, and 5,100 was that spot, that line in the sand that held the highs again. And then again, and when I looked at this last week, we were right there. We were right on the verge of breakout. That breakout hit right into the new week, and we ran right up to the next zone of resistance, 52.38 to 52.70. And even that remained clean. The pullback from that supported prior resistance, and then right back up to resistance. This is still a market. I'm not looking at this as correlated to the USD at the moment, but I do think dollar weakness would help out here. I think there's kind of an agreement of themes between these two markets where a weaker dollar helps to play out for stronger gold prices. And this is something that I think still holds some breakout potential as we go into next week. So I wanted to at least look at it. But that said, I don't like chasing fresh breaks, especially around a weekly close and a weekly open. So it's this area that I want to see play as support. It's right around 5,200 to 5,191. If we could get a pullback, look for support in there. I could call that a higher low, and then I could look for a move back up, a recursion to this resistance zone, and then maybe even that next level up at like 53.78. But I think what's most exciting in gold is if you look at this on the weekly chart, it looks like bulls are back in a very big way. There was some tension, there was some pressure. You see these underside wicks. You could see where bulls are getting more and more anticipatory of a rally, of a run. And this week is where that all kind of capsized. So as we go into next week, bulls have a full head of steam. Just want to be careful on timing of entries or around entries. But, if we're looking at an ascending triangle, that is the picture-perfect textbook illustration of how one would fill in if it does what it's supposed to do. Now, not all formations fill in. Oftentimes, formations will fail. And that's why I always look at counter scenarios around the dollar as we go into each week. In DXY, again, it's a composite. So if this is going to break out, if this is going to show strength, we're going to need to see weakness from somewhere else. Likely the euro to a degree, but also dollar yen. Now, the reason that I say and think that dollar yen is still carrying a big weight here is when we look at this dynamic in USD, like we had that harsh sell-off from January 19th to January 27th. If you look at what happened in dollar yen, it gives some definition as to why. It was that sell-off on January 23rd around the BOJ rate decision. It was, again, a harsh 3-day sell-off, but finally found some support down here. And what I think is happening is I think we're seeing a degree of positioning unwind as we get closer and closer to a vaulted spot on the chart. It's that 160 handle. Now, there is an old saying, price leads narrative. And so this week we started to see some reports where it was indicating that Takeichi is hoping to drive this trend of yen weakness, of dollar yen strength. But I think that's just mirroring or echoing price action, because, you know, the reality is we've gotten closer to that 160 spot. We've seen bulls cut and run. This chart shows it fairly clean if we go out longer term. But if we go back to that carry trade saga, like in 2022, it was the 150 level, initially 145, where the finance ministry started to try to scare everybody. And, you know, market participants they're going to challenge you if they can. And that's precisely what happened. Notice where we had like 3-4 weeks of resistance at 145, and then there was no intervention. So I was like, all right, let's test them. Let's see what they got. Go up to 150. We had one daily close above 150. And then body slam. Now, that was an intervention. You could see where it didn't lead to a direct reversal. It was a pullback. What ultimately brought this reversal was below expected CPI a few weeks later. But that it shows where a crowded trade becomes a crowded exit. But the old saying of up the stairs, down the elevator, it's exactly what you get when you get one of those crowded one-sided trades. A similar scenario back here, there was no direct intervention, but as we got closer to that same 150-195 level that set the high a year earlier, there was like the sneaking suspicion that the finance ministry was going to jump in if they needed to. Lo and behold, below expected CPI, another pullback. That was just a 23.6% pullback of the 21 to 22 move versus the 50% pullback we had a year earlier. But again, market participants, they're going to test and test and test until they know better. And that's exactly what happened in 2024. We got back up to that 150-195 level. And ultimately, it was a CPI report in April, above expected. It brought the thought that maybe the Fed wasn't going to be able to cut later in the year. We get that breakout in dollar yen, and then we went right up to 160, and then the finance ministry is like, nah, we got to step in. They step in, they intervene. Notice that it was just like 1 week of weakness, though. I mean, really, all they did was back bulls off the bid for a little bit. And then buyers jumped in at that same 150-195 level that it set support, or excuse me, set resistance earlier. Now it's support. And then they go right back up to 160. The reason this one worked out so well is, it maybe a little too well, is the BOJ had some help. We had a below expected CPI report, same morning of an intervention. And this is what I think is relevant for current day, because this shows the finance ministry and the BOJ adapting to market environment, to the market environment. Because at that point, not only did dollar yen trade above 160, we had a bid above 160. We had a pullback and a rally back up. But the morning of July 11th was US CPI report, and it's like the BOJ was standing at the ready. They were ready to hammer this thing. It just so happened that CPI came out below expected, so now there was reason for that crowded trade to take off some risk. And not only did we have the intervention, we also had the unwind scenario, and before you know it, we have a spiraling situation here in dollar yen. And it took a couple months. Not until just a couple days ahead of the Fed's rate cut in September did this finally get some support at 140. But, you know, similar deal. We've had a couple of strong rallies back up, but since then, it's like bulls don't even want to test 160. They're afraid that that's where the BOJ is going to step in. And in the more recent scenario, as we got closer, we started to get those hints from Katayama and current finance minister Katayama. We started to get those hints that the BOJ was or the finance ministry was looking at that 160 as the line in the sand that was going to be defended. And it was like bulls didn't even want that noise. They stepped back before we even got the test. But, if you think about it, as we get like 50, 60, 70, or even 100 pips away from that 160 handle, the perceived risk reward on the setup changes, it shifts. If there's only 100 pips of upside before we get a sweeping intervention kind of run, is that really a risk that you want to take? Maybe not that attractive from a return upside setup, right? And so I think that's why we've seen a propensity for these highs to build below 159. And that's what I think happened around the BOJ rate decision right back here. I think it was simply a situation of unwind as we got close to that 159 handle or tested that 159 handle. And the BOJ highlighted the possibility of hiking rates. And so I think there was reason for some of those longs that have been holding on that got long at 142, 145, 148, 150 even. Or even if it was something, it was the Takechi win back in October that got this above 150. Even if somebody got long at 150, we get 159, 158, not a terrible time to take profits and then look for a pullback, which is precisely what happened. But what I think is relevant here, and this is why I maybe have some skepticism on bullish potential in the USD at the moment, is what happened after the fact. Like when we went in to this week, it was snap elections in Japan. Takechi, again, you saw that bullish reaction in dollar yen on her win back in October. She called snap elections. Widely anticipated that her LDP party and their coalition was gonna win. They did. They got a 2/3 majority. A lot more room to operate. It was widely expected this was going to lead to dollar yen strength, but notice, we had an initial reaction of strength after that open, right in here, but then it was body slammed, and then just continued to bleed out. And then later in the week on that Wednesday, we had an NFP report, a strong NFP report. Same thing, initial reaction strength, exactly what one would have expected. And then it got slammed right from resistance. It seems like if there was an intervention over the past month and a half, I don't think it was here. I think it was here. And Katayama had a comment back in January when we were working on these lower highs, when she said she spoke to the U.S. Treasury Secretary Scott Bessent, and they both agreed that a weaker spot rate in dollar yen made sense. And that sounds like both Japan and the U.S. want this lower, where Takechi wants to push stimulative policies, which should equate to yen weakness, but then there's the fear of inflation if you have Japanese yen weakness. On the other side of that, Trump has been very vocal and open about his desire for USD weakness. This seems like something, the old saying is don't fight the Fed, but maybe a better saying is don't fight the Bank of Japan and the U.S. Treasury Department at the same time. I don't know. But price leads, narrative follows. For now, this short-term trend is still bullish. What I'm looking at for support, and this is still my long or bullish USD setup, what I'm looking at for support is this zone here, 154.45, 155. If it gives that up, 153.67 is my S2, and then this is my S3. If it gets below this 151.95 level, then we're looking at an entirely different scenario. And if you just look at this from a 3-4 year perspective, it has been mean reverting. And so if we get rid of that, if we get below that zone, then something has shifted, something has changed. That's when I think the dollar could really take a bath. And I think in that scenario, there's more interesting setups than trying to chase the short side of dollar yen. But for now, short-term price action is bullish. I'm sticking with that. Need to see a bit of a pullback before I could work anything off of an entry, but that's my long dollar setup. And that's what I think is the main driver on the USD at the moment. For short side USD, if we are looking for that DXY setup to fail, I'm still following Eurodollar. It hasn't been a very exciting backdrop in Eurodollar, admittedly, but we did get a big spot of support coming into play at that 117.47, 48 Fibonacci level a week ago. It's been a grinding week here, just as it has in the USD, but there have been higher lows, and we have seen bulls starting to test out of that falling wedge formation a bit. But if we do get breakdown in the USD, this is the one that I think is pretty attractive. Now, like I said, I think dollar yen is doing the drive here, and as evidence of that, we can look at the way that Eurodollar popped through 120 in January. And, again, it was that run after the BOJ that was on the 23rd right here, where we really saw that profuse USD weakness. And so, to my eyes, it was carry unwind in dollar yen, leading to dollar weakness in major pairs, dollar yen included, but euro dollar, pound dollar, etc. If I am looking for USD weakness, I like the idea of this support holding up, of that falling wedge eventually giving way. I think this is a bit more attractive than what I have in dollar yen at the moment. Pound dollar, I still have on the short side of the USD radar, but it's not as attractive. Now, you could see, again, another falling wedge, or a falling wedge, that had played out beautifully back in January. Similar dynamics where you have sellers hitting us aggressively on these pullbacks that are timid and shallow at support. Invariably, that leads to reversal. More recently, same, where sellers have been kind of shy around support, especially below 135. There's been a propensity for buyers to show up below 135 under that perceived value perspective. Meanwhile, sellers have still been hitting resistance. They did it again this week off that level. Looked at this in the webinar on Tuesday, 35.68, which so far has held. But notice the underside here is 34.34 that has put up a pretty decent fight. So I'm keeping this on the short side of the radar, short side of the USD radar for now. But what I need to see is a break and a support test, ideally above that 135 level. That's a major spot in cable. But this might end up being more attractive than Eurodollar. It's just not as bullish now. Like in Eurodollar, I have those higher lows from this week. I don't have the same argument to be made in cable. All I have is respect of that 34.34. So could still keep it open, but not as clean as Eurodollar that we looked at a moment ago. I'm keeping this one on the long side of the USD radar, but this one has to get its act together soon. I wrote about this one pretty extensively over the past week and talked about it in the webinar, but this level here, 37.27 back in August and September, built a beautiful textbook double bottom formation in dollar CAD. Double bottoms are bullish reversal formations. The way they work is a break of the neckline opens the door for reversal. That's precisely what hit in here. And then with that formation, you'll often look for the distance from the bottom to the neck, and you'll project that for a top-end resistance target. And that filled in beautifully. Eventually got the 140 test. But that 37.27 price is now back in play twice as resistance. I think there's still a bullish case to be made here, given the hold of 135. Like, this shows well on the weekly there. You can see where that 135 level came into play as support a couple of different times. But like USD at that resistance, it just hasn't been able to get above 37.27 yet. That said, I do have this at a spot of support. This shows cleanly off the 4-hour. It was this swing low back in just like December. But it came back in as support and then as resistance. Now it's back in as support. So that's why I say it has to get its act together rather soon. I needed to hold that level to keep the door open as a higher low to allow for a challenge into 37.27. Now, this is a pretty cool setup because it's not just about trying to predict the way prices are going to move based on how they've moved in the past. It's about strategy around them. So the way to work something like this, 37.27 has been resistance twice already. And it may end up holding as resistance in the same way that it held as support back here. But given that we have a possible higher low, as we see off that 4-hour chart, I could essentially look for or try to set this as a short-term bullish trend with retest in 37.27. The plan being, if we get up to 37.27, and if I'm holding a long position still, I could scale out of a part of the position. I can move stops to break even, wherever that might be, and then look for breakout on the remainder. And that way, if it doesn't hit breakout, so be it. Just another failed breakout test. But if it does hit breakout, then beautiful. I could get a runner on the back end of that lot or the back end of that position, only managing off a portion of the risk with a scale out on the way up, break even stop on the rest, so that if it does move against me, at least I don't have to give up too much of what I initially scaled out, and hopefully that break-even stop executes at or around that break-even level and doesn't get gapped through. But that's one of the reasons you want to be careful around weekend trading, because there is the high potential for gaps around weekends. But that is one way to use a trend or a short-term trend with a longer-term breakout setup. I don't like trying to get breakouts right at the point of break because of exactly what happened in here. And if it does wick above that resistance and then you chase a break, then managing that risk is going to be incredibly difficult, because if we get just this minor pullback Now you're in an upside down position, and you got to ask yourself if you really want to hold on for the ride, which I often don't. I want to cut losers really, really quick. But if trading the trend, if getting a bit of a rally, there's a way to play breakout if you manage the position by closing off a portion, letting the rest run. And if it does run, great. And if it doesn't, so be it. But that, my friends, is what I have for next week. Like I said, USD is in a pretty pensive spot. Whether or not it breaks, I think it's going to go back to dollar yen. And if it doesn't, I think that set up in euro dollar, pound dollar play a lot more attractively. And then gold kind of doing its own thing, but it's back in those very bullish ways. So as always, thank you for your time and happy trading, ladies and gentlemen.